Despite its well-known volatility, cryptocurrency is on fire, and many investors are trying to profit from the market's meteoric surge. Let's talk about how you can start investing in cryptocurrencies and what you need to avoid to become successful. Bitcoin and Ethereum, as well as many other prominent digital currencies, ebb and then surge. While seasoned traders have been speculating on cryptocurrency for years, what if you're new to the market and looking to participate? Welcome to another The Trend video. In this video, we are going to talk about how you can start investing in cryptocurrencies. Before moving further, kindly like this video and subscribe to our channel so that you don't miss our upcoming amazing videos. So here's how to get started investing in cryptocurrencies and what to avoid. 1. Understand how cryptocurrencies work. While Bitcoin is the most well-known cryptocurrency, you may purchase thousands of other cryptocurrencies and crypto tokens. However, the majority of these share some characteristics. They rely on distributed ledger technology. The usage of blockchain ledger technology is a significant innovation behind cryptocurrencies. These are public databases that are used to track transactions that cannot be altered once fresh data, a block, is added to the existing chain. This transparency and durability contribute to ensuring that cryptocurrency is not duplicated, spent twice, or manipulated in any way. Moreover, numerous blockchains exist. Each cryptocurrency may have its own distinct blockchain. For instance, there are distinct blockchains for Bitcoin, Binance, and Ethereum. Additionally, they are distributed. Individuals and businesses from all over the world utilize their computers to assist in the operation of blockchains and are compensated in return. Due to the distributed nature of the database and processing power, there is no centralized authority, such as a firm or government, that has control over what has occurred. Besides, cryptos are only lightly regulated. While cryptocurrencies are still in their infancy and regulations are hazy, state and federal agencies have demonstrated that they are capable and willing to regulate them. However, this does not mean you are safe or should believe anything you read on a cryptocurrency company's website. While the basic technology is similar, you can invest in cryptocurrencies designed for a variety of purposes. For instance, Bitcoin was designed as a digital form of payment, whereas other coins enable users to access certain cryptocurrency platforms or applications. 2. Understand what you're investing in. As with any investment, ensure you understand what you're getting into. If you're purchasing stocks, it's critical to read the prospectus and conduct extensive research on the companies. Prepare to do the same with any cryptocurrency, as there are practically thousands of them, each with a unique function, and new ones being generated daily. Each trade requires an understanding of the investment case. Numerous cryptocurrencies are not backed by anything, neither hard assets nor cash flow. That is the situation, for example, with Bitcoin, where investors rely only on someone else paying more for the product than they paid. In other words, unlike stocks where a corporation may increase revenues and so generate returns for you, many crypto assets require the market to become more hopeful and bullish in order for you to profit. Ethereum, Dogecoin, Cardano, and XRP are just a few of the most popular coins. Solana has also been a highly successful coin, so before investing, be aware of the potential upside and downside. If you make a financial investment that is not backed by an asset or cash flow, it may become worthless. 3. Remember, the past is the past. A common error made by rookie investors is to look at the past and extrapolate to the future. Yes, Bitcoin was once worth pennies, but it is now worth significantly more. The critical question, though, is, will that growth continue in the future, even if at a slower pace? Investors are concerned with the future, not with the previous performance of an asset. What will be the future drivers of returns? The point to note is that traders purchasing cryptocurrencies today require future gains, not yesterday's. 4. Keep an eye on volatility. Cryptocurrency values are about as volatile as any asset can be. They can vanish in a matter of seconds based on nothing more than a rumor that turns out to be untrue. This can be advantageous for knowledgeable investors who can execute trades quickly or who have a firm grip on the market's fundamentals, how it is trending, and where it may go. It's a minefield for new investors lacking these abilities or the high-powered algorithms that execute these trades. Volatility is a game for Wall Street's most powerful traders, who are all competing to outgun other wealthy investors. Volatility can quickly crush a new investor. This is because volatility frightens traders, particularly newbies. Meanwhile, other traders may intervene and purchase at a discount. In short, volatility can benefit professional traders by allowing them to buy low and sell high, while naive investors can benefit by buying high and selling low. 5. Take control of your risk. If you're trading any asset on a short-term basis, risk management is critical, and this is especially true for volatile assets like Bitcoin. As a rookie trader, you'll need to grasp how to manage risk effectively and build a method for mitigating losses. And this procedure is unique to each individual. For a long-term investor, risk management may simply mean never selling, regardless of the price. The investor's long-term perspective enables him or her to maintain the investment. However, risk management for a short-term trader may include establishing rigorous standards for when to sell, such as when an investment has declined 10%. The trader then follows the guideline religiously to ensure that a relatively minor decrease does not turn into a crushing loss later. New traders should consider setting aside a particular amount of trading capital and then just spending a fraction of it initially. If they lose a position, they will still have money in the reserve to trade later. The bottom line is that you cannot trade if you lack funds, so maintaining a reserve fund ensures you will always have a bankroll to fuel your trade. While risk management is critical, it will come at an emotional cost. While selling a lost position is painful, it might help you avoid worse losses in the future. 6. Don't invest more than you can afford to lose. Finally, it is critical to avoid investing funds that you require in speculative assets. If you cannot afford to lose it all, you cannot afford to invest in risky assets like Bitcoin or other market-based assets like stocks or ETFs. Whether it's a down payment on a house or a significant forthcoming purchase, money that you will need in the next several years should be saved in safe accounts to ensure it's available when you need it. And if you want to guarantee return, your best bet is to pay off debt. You are assured to earn or save regardless of the interest rate on the debt. There is no way to get lost there. Finally, pay close attention to the security of any exchange or broker you use. While you may legally possess the asset, someone must nevertheless secure them, and their security must be strict. If they believe their cryptocurrency is not adequately secured, some traders opt to invest in a cryptocurrency wallet that stores their money offline, making them inaccessible to hackers or others. The takeaway: cryptocurrency is a very speculative segment of the market, and many prudent investors have chosen to diversify their holdings. However, for beginners interested in trading cryptocurrency, the best advice is to start small and only invest funds that you can afford to lose. While cryptocurrencies provide a novel and intriguing financial possibility that may be worth examining, bear in mind the risks and educate yourself on the various cryptocurrencies and crypto projects in order to identify opportunities that interest you and fit your investing style. When considering a new investment, ensure that you have the funds to fulfill your bills and debt obligations, as well as an emergency reserve and retirement savings plan. And with that being said, that's all from today's video. What are your thoughts on this? Do you believe cryptocurrencies are a viable investment opportunity? Let us know in the comments section below. Thanks for watching this video. If you found it informative, do like and subscribe. And don't forget to give comments and provide us with your valuable feedback. Plus, if you want to suggest a topic for the next video, feel free to tell us. See you in the next video, and until then, stay tuned to the trend.